If you hold ETH, chances are that you've been hodling for a while now, and you're probably finally starting to see some profit. Hallelujah. But the best part is that there are ways that you could actually stake your ETH to earn extra rewards and grow your portfolio even further. And thanks to liquid staking tokens, you don't even need 32 ETH to get started. That's why today we'll tell you everything that you need to know about the top 5 liquid staked ETH tokens. My name is Lewis, and this is a video that you cannot afford to miss. Before we begin though, you do need to know that I am not a financial advisor and nothing in this video should be considered financial or investment advice. This video is simply intended to inform you about liquid staked ETH tokens. And if you want more content like this, then decimate those like and subscribe buttons and hit that bell notification too so that you never miss another episode. Now, if you're unsure what liquid staking tokens are, don't worry, your secret is safe with us. To understand why there's such a big deal though, we first need to understand how regular old staking works. As most of you will hopefully know, Ethereum uses proof of stake, whereas proof of work blockchains are secured by miners, proof of stake chains are secured by locking up or staking crypto, and in this case, ETH, which is then used to validate transactions and secure the network. You could think of staking ETH as being a sort of deposit. If you validate transactions incorrectly or do something else that's malicious, you risk losing your ETH deposit. The trade-off is that you earn a staking reward if you don't step out of line. The catch is that while your ETH is staked, you can't do anything with it. You can't sell it, trade it, or move it around. It stays locked in place until you choose to unstake it, which can take days. You also currently need 32 ETH to run your own validator node, which is not cheap. For investors who don't mind locking up their ETH and already have 32 ETH, regular staking works just fine. But if patience isn't your strong suit and you're not rolling around in a Lambo, how do you minimize opportunity costs while your ETH is locked? That is where liquid staking tokens, or LSTs, come in. LSTs are liquid because they remain usable even while your actual ETH is locked. They could be sold, transferred, traded, or used in DeFi protocols just like regular ETH, while you continue earning staking rewards. This lets you seize opportunities without giving up your staked assets. If staking ETH is like depositing it, an LST is like getting a receipt for that deposit that you could trade. Usually, LSTs are issued one-to-one to the amount of ETH being staked. This means that when you want to redeem your actual ETH, all you need to do is return the liquidity tokens and your native ETH will be unstaked and returned. It's like showing your receipt to reclaim your ETH deposit. The caveat, though, is that this novel process comes with additional risks. One risk is that there's a delay in redeeming your LST receipt for the underlying ETH. This could impact the value of your LST and how much ETH you're able to redeem. Another risk involves counterparty risk. In order to receive LSTs, you need to stake your ETH in a liquid staking protocol. These protocols will basically stake the ETH that you give them using a series of special smart contracts connected to Ethereum validators. These smart contracts are built to be robust and secure, but no system is flawless. An exploit of these contracts could wipe out your ETH, your LSTs, or both. For what it's worth, none of the liquid staking protocols we'll be covering today have ever been hacked or exploited. Now, you should know that you don't need to stake your ETH to get an LST. You can also buy LSTs on exchanges. And if you're looking to buy a liquid staked ETH token, then you have to check out the Coin Bureau deals page, because that's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. All you need to do right now is hit that link in the description or scan this QR code, and once you're on the deals page, you will see all of our offers across all the different ranges of exchange partners. Then just click one of these sign up now buttons and that should take you right to the deal. Now remember, these deals, they won't be around forever, so take advantage of them while you can using the link in the description or the QR code on the screen. Okay, so now that we understand what liquid staked tokens are and how they work, let's take a look at liquid staked ETH tokens from the top 5 protocols. The largest of all is Lido Finance, which offers Lido Staked ETH, or stETH. Lido was founded in 2020 by Konstantin Lomashuk, Vasily Shapovalov, and Jordan Fish, better known in crypto circles as Kobe. Investors included MakerDAO creator Rune Christensen, Aave CEO Stani Kulikov, and Synthetics founder Kane Warwick, alongside Semantic Ventures, Parify Capital, and Terra. The protocol's governance is overseen by the Lido DAO, which is controlled by holders of the LDO token. Of course, the Lido DAO has voted on some big changes to the protocol over the years. For example, Lido once supported multiple staking blockchains outside of Ethereum, including Solana, Polkadot, and Polygon. But in February this year, the Lido DAO chose to sunset the support for these other chains. Today, Lido exclusively provides staking services for Ethereum. Now, in case you missed it, Lido is Ethereum's largest liquid staking protocol. In fact, 19% of all ETH staked on Ethereum comes from Lido, which is actually considerably lower than what it used to be. At one point, Lido accounted for around a third of all staked ETH. Anyways, when a user deposits ETH into the Lido protocol, they receive staked ETH on a one-to-one basis. There's no minimum staking requirement for Lido, nor are there any lockups, hence why Lido became so popular so quickly. At the time of shooting, staked ETH has a market cap of around $42.1 billion and currently offers an APR of 2.7% compared to the 3% you'd get for staking ETH natively. That's because Lido charges a fee of roughly 10% on all earned staking rewards. In terms of adoption, stETH is the most liquid Ethereum LST for trading, borrowing, and liquidity mining. It's widely integrated across major DeFi protocols like Aave, Uniswap, and Curve, and with no KYC requirements, almost anyone with an internet connection can access stETH. Regarding technology, stETH maintains its ETH peg in 3 ways. The first is good old-fashioned arbitrage. Basically, traders buy stETH when it falls below ETH's price, and then they redeem it for ETH at a profit, or vice versa. The second way staked ETH maintains its peg is through liquidity mining, where the Lido DAO provides rewards to anyone providing liquidity for trading pairs between staked ETH and ETH. The third way the peg is maintained is through organic demand for the stETH itself. Because stETH earns staking rewards in real time, it's the ideal collateral for lending protocols. And because stETH is a rebasing token, this means that its value is frequently adjusted to maintain its ETH value. However, this rebasing also makes it incompatible with certain DeFi protocols, including decentralized exchanges such as Uniswap. That's why there's also a wrapped version of staked ETH called WSTETH, which is designed to be compatible with DeFi protocols that don't support stETH's rebasing features. Basically, this means that your staked ETH can continue to increase in value while maintaining a fixed price that's suitable for DEX trading. Okay, so the second largest Ethereum liquid staked token is Beacon ETH, or bETH, which comes from Binance, the world's largest crypto exchange. bETH was first introduced by Binance back in 2021, ahead of Ethereum's merge. It's important to note that bETH technically doesn't exist anymore as it was fully replaced by wrapped bETH, but this requires a bit of context. You see, before the merge took place, people could stake by depositing 32 ETH, which could be withdrawn once the transition was completed. The problem, though, is that not everyone could afford 32 ETH, and for a long time, it wasn't even clear when the merge would actually be finalized or how long this ETH would be locked away for. So Binance introduced bETH to give people an alternative, allowing them to stake their ETH on Binance in exchange for LSTs, which were not subject to an indefinite lockup period. However, just like Lido's stETH, Binance's bETH required a wrapped version to be compatible with DeFi protocols. As such, the exchange introduced a wrapped variant called WBETH in April of 2023. Toward the end of 2023, Binance began to phase out bETH altogether in order to streamline its staking services to be more user-friendly. Today, users automatically receive WBETH when staking their actual ETH. Note that users still holding bETH can convert it to WBETH without paying any additional fees. Obviously, WBETH is different from other LSTs like stETH because it's governed by a centralized entity, which is Binance. And if it wasn't already obvious, this also means that minting and redeeming WBETH requires setting up a Binance account, which means completing KYC and doing everything else. Anyway, according to the data from Etherscan, 6.1% of all staked ETH comes from WBETH. And according to Binance's landing page for its ETH staking services, the protocol has staked over 3 million ETH at the time of shooting. That works out to a market cap of 15.5 billion. Currently, you could stake ETH with Binance to earn an APR of around 2.43%, which is slightly lower than what you'd earn with Lido. The caveat is simplicity, since most people already use Binance and its staking feature is integrated into the platform pretty comfortably. The minimum staking amount is just 0.0001 ETH, about 47 cents at the time of recording, which I'm sure you'll agree is negligible. Binance charges a 10% commission on all staking rewards though, and redeeming WBETH for ETH takes 6 days. Unlike bETH, which was pegged 1-to-1 to the value of 1 ETH token, WBETH works a little bit differently. That's because WBETH is a value accruing LST that represents 1 staked ETH, plus any earned staking rewards. These rewards are compounded to maximize their value and are reflected in the conversion rate, which is updated daily. Now, the third largest Ethereum liquid staked token is Rocket Pool's rETH. Rocket Pool was founded in late 2016 by David Rugendijk after Ethereum creator Vitalik Buterin published the mETH paper, where Vitalik first outlined his vision for a proof-of-stake Ethereum blockchain. This inspired Rugendijk to work on a decentralized staking solution for Ethereum. However, the protocol didn't launch until November of 2021. In any case, Rocket Pool received early backing from major investors including Coinbase Ventures, 1KX, Consensus, Struck Capital, and FJ Labs. Like Lido's stETH, minting and redeeming Rocket Pool's rETH doesn't require KYC. All you need is an internet connection. Unlike Lido, Rocket Pool uses a dual DAO model. The protocol is governed by a protocol DAO, and any upgrades are tested and carried out by an Oracle DAO. Both DAOs use Rocket Pool's native RPL governance token to make key decisions about the future of the platform. This approach ensures that no single entity controls the network or Rocket Pool's development, which arguably gives it added decentralization compared to Lido. According to Etherscan, Rocket Pool is responsible for just 0.81% of staked ETH, and according to Rocket Pool's website, the protocol has staked around 650,000 ETH. At the time of shooting, rETH has a market cap of 2.2 billion. There's no lockup periods, but there is a minimum stake of 0.01 ETH required to obtain rETH through Rocket Pool, which will earn you an APR of 2.45%. Unlike other LSTs in today's video, Rocket Pool doesn't use a wrapped version of rETH. However, because rETH is a non-rebasing token and fully ERC20 compliant, it has no troubles with DeFi integration. Because rETH is backed 1-for-1 for actual ETH, Rocket Pool maintains the value of its rETH token. And when the price of rETH deviates from the price of ETH, traders will naturally sort this out with a bit of arbitrage trading. rETH represents the user's staked ETH plus any earned staking rewards, priority fees, and MEV rewards. Now, Rocket Pool uses a clever staking model that allows validator nodes to stake just 8 or 16 ETH, which is then supplemented by ETH deposited into a staking pool to form a so-called mini pool. This lowers the barrier to entry, helping validators meet the 32 ETH staking requirement. And this further increases decentralization. Notably, Rocket Pool itself doesn't take a cut of any of the fees, which only furthers its decentralization efforts. Instead, node operators on Rocket Pool earn a 14% commission from the staking rewards generated by the ETH added into the mini pool by non-validating stakers. Okay, so now we're on to the fourth largest Ethereum liquid staked token, which is mETH. And I know what you're thinking. No, mETH is not the stuff that was mass produced by Walter White and Jesse Pinkman in Breaking Bad. It's actually Mantle's Staked Ethereum LST token. For those unfamiliar, Mantle is a modular layer 2 blockchain launched by BitDAO in 2022. FYI, BitDAO was launched by Bybit crypto exchange with backing from tech billionaire Peter Thiel and venture capital from Pantera Capital. In June of 2023, the Mantle network and BitDAO merged to create a single entity simply called Mantle. Its mainnet was launched the following month. The mETH protocol, on the other hand, launched in July of 2023. Originally, it was called Mantle LSP, before they rebranded it to the mETH protocol in August of 2024. The mETH protocol is governed by Mantle and holders of the mETH protocol's governance token, which is called none other than Cook. Yes, really. As a cherry on top, the platform doesn't require KYC, just an internet connection. Notably, the mETH protocol doesn't use its own validator to deposit ETH, but instead it uses 4 external validators. These are A41, P2P, Blockdaemon, and Stakefish. The protocol's website claims to have staked more than 380,000 ETH. At the time of shooting, mETH has a market cap of 1.4 billion. There's a minimum stake of 0.02 ETH, and the protocol offers an APY of 2.74%. Notably, the mETH protocol charges a 10% fee on all rewards, and a tiny 4 basis points fee on user deposits, although for what it's worth, withdrawing is completely free. As with other liquid staking protocols, when users deposit ETH into the mETH protocol, they receive mETH at a 1-to-1 basis, helping to maintain mETH's value. However, mETH is a value accruing token, so its value will increase over time as the users hold it. We should also note that the mETH protocol has a second token called cmETH. In a nutshell, cmETH is a liquid restaking token that allows mETH holders to restake their mETH in a number of different protocols. These include EigenLayer, cbETH, Carrick, and others. cmETH holders can then accrue additional rewards in third-party assets. What's crazy, though, is that according to the mETH protocol's website, over 196,000 mETH, roughly 50% of all ETH staked via mETH, has been restaked into cmETH. Only in crypto could doubling down on your mETH be considered bullish, eh? And that brings us to the 5th largest Ethereum liquid staked token, cbETH, which was issued by a little-known company that you may know called Coinbase. cbETH was first introduced by Coinbase in August of 2022, just in time for the completion of Ethereum's merge the following month. As you'll have guessed, Coinbase governs the cbETH token, rather than a decentralized entity or autonomous organization. This means that Coinbase governs the minting, burning, and custody of cbETH through a centralized trust model. And since you'll be dealing with Coinbase, arguably one of the most regulatory compliant exchanges in the world, you will need to complete KYC in order to mint and redeem cbETH. Coinbase is currently the 3rd largest depositor of ETH behind Lido and Binance, at 6% of all ETH staked. At the time of shooting, cbETH has a modest market cap of over 680 million. There's no minimum staking requirement, and users could earn a healthy APY of 2.94%, the highest APY of any Ethereum LSTs in today's video. There is also no unlock period for reclaiming the underlying ETH, but the protocol does charge a 10% commission on staking rewards earned by cbETH. And that reminds me, cbETH is a value accruing LST, which once again means that the conversion rate is adjusted upwards in order to allow the user to claim additional ETH when they choose to redeem their cbETH tokens. Even so, Coinbase has designed cbETH to be compatible with DeFi applications. That's because cbETH is a wrapped staking ETH token by design, which means that it could be sold, transferred, traded, or used in DeFi protocols right away. And remember, if you're looking to trade cbETH or any LST mentioned in today's video, you could always use one of the exchanges in our exclusive deals page to really maximize your ETH gains. The link will be down in the description. And that's going to be it. That is the top 5 Ethereum liquid staking tokens. So I hope that you found this video useful. And if you did, smash that like and subscribe button because you know that you have to show this video some love. And we talked all about liquid staked Ethereum in today's video. But if you want to see which projects on Ethereum could have serious potential that aren't staked ETH projects, then check out the video right over here. And if you want to learn when to sell your altcoins, well, then you could check out this video right over here. Thank you so much for watching. My name is Lewis, and I will see you in the next one.